about having this chat with Nick Goodall, Head of Research at CoreLogic. So Nick and I are just going to have a chat probably for the next half hour, 45 minutes, and run through what we're seeing from a Trade Me Property and a CoreLogic perspective. Morena, Nick. How are you getting on?
Kia ora, Gav. Yeah, good, mate. Good, very good. Obviously, very happy being based in Wellington here at the news of moving to level 2 tomorrow, but do feel for all you Aucklanders out there. So stay strong, guys. I know it's tough, so hopefully not too far away for you guys too.
Yeah, a bit of freedom for you guys, which will be quite nice. Who knows what's ahead for us, but things are looking encouraging at the moment anyway. I'm also happy you got a shirt on, Nick. I was debating to go with the shirt, so good to see you. We're replicating each other there, mate. It's the finer details, right?
I had a catch up with my boss yesterday, and he was presenting straight afterwards and had a tie on, and I thought, oh geez, it really is getting formal. So I haven't quite gone that far, but definitely managed to get a shirt out of the wardrobe for today.
Absolutely, you're in trouble if I've got a tie on. I'll tell you that much. Hey, just a quick run through for everyone that's tuning in. Again, great to see the interest that we've had in this webinar. So hopefully we can get through all the points of interest. Thanks very much for sending through your questions. So as I touched on, Nick and I will just have a quick chat around the property market with a bit of a focus on what the current lockdown and the impact that may have. And then we'll move at the end, probably for the last 20 minutes or 15 minutes, just through some questions. So thanks very much for everyone that's sent through those questions. We did get a pile of them, so unfortunately we probably won't be able to get through all of them. But anyway, look, let's get underway, Nick. Why don't you kick us off with a bit of a summary on the market at the moment?
Yeah, mate, we'll do. I think that it's obviously a pretty intriguing time, but I think it's always worth just sort of putting a line in the sand and giving a decent picture of where the market's at right now. So I'm just going to run over a relatively brief market overview, and then we'll get into some of the more specifics around exactly what's happening now, what we expect as we come out of lockdown, and I think Gav will also give us some data from the Trade Me browsing and information as well to give us some stats on what people are doing right now in terms of interaction through the site. So I'm just going to take a few minutes to run through a few slides, and I'm sure Gav will throw a few questions at me from the questions that you guys have submitted. So I'll kick off, and I think it's worthwhile acknowledging, yes, we've had a very strong growth phase, but we are seeing that growth rate start to slow now. So as you can see on the chart on the left-hand side there, our quarterly growth rate now, according to the CoreLogic House Price Index, has slowed to 5.2% quarterly growth. Still a very high rate of growth. We should acknowledge that. But in the context of the recent growth rates, back at April, it was 8.1% quarterly growth. So we are seeing things start to tail off. And I think what's really interesting when you look at the more granular, level data at the city level or TA level, you can start to see that there's some areas that have actually just dropped minor into negatives. Down the bottom of that chart on the right-hand side, you can see both Hamilton, very minor drop over the last quarter, and also a little bit of a greater drop, just over 2% in terms of values, just dropping a little bit there. We do expect it to be relatively short-lived, but I've included a few other main urban areas on that chart on the right-hand side, just to show that there's still some growth left in the market. Some areas, the quarterly growth rate from July to August did actually increase. So it's certainly not across the board, but definitely the majority of areas we are seeing that slowdown start to occur. And across the nationwide figure, we've seen it sort of come down off that significant high we saw at the start of this year.
Hey, Nick, probably preempting probably a little bit later on there, but in terms of what we're going to cover on in terms of the recovery side of things, but that drop that you have seen, do you think that may turn around given the lockdown and some of that pent-up demand that we're probably going to see in the next little while?
Yeah, I do think that, naturally you go into lockdown, we see fewer people able to list their property, and we do see people sit at home and start to search properties. So we do get this pent-up demand, and at the same time as we see a lack of supply, an even greater lack of supply. We already know we're at all-time low listings levels, and that might cause a sort of short bump to prices, and so we might see a little bit of a lift to that quarterly rate over the next month or two, but we don't think it's long lasting. And I think we will touch on that in a little bit more detail as to why we think about that. But in the short term, now as the rest of the country comes out of that harsher lockdown, we do think there might be a little bit of a bump to prices that might just show a little bit of a resting of that slowdown. So, I mean, moving on to sales volumes in terms of the amount of sales that have been occurring so far, it's a pretty similar story, really. Sales volumes have settled back from that recent high. Here, it's a lot of data in this one. Obviously, the left-hand chart is New Zealand sales monthly, and the red bar is July. We're still sort of collating August sales volumes, so there's no August data on this one just yet. But I think the key thing when you look at July's sales volumes on their own, still a very strong month, but well down from the heights we saw at the end of last year. The number of sales in the last few months last year, upwards of 10, 11,000 per month, which is exceptional sales volumes, carried on through the start of this year through to March. But we have seen that gradual slowdown, the number of sales that have been transacting this year, but still hovering well above where we've sort of been the last 5 years. And you can see that when you compare that red bar this year with the same red bar in the last 2, 3, and 4 years. So you can just see we're still quite high, but it has come down off that absolute peak. I think what we're looking at now is that we are seeing some regional differences start to show up. That chart on the right-hand side is just an example of an area where we have seen sales volumes drop away a bit harder, and that's in Dunedin. And you can see Dunedin, again, the red bar is July. It's actually below the average or the number of sales for July for the last 10 or so years, actually. And so we have seen sales volumes come back quite sharply in Dunedin. And we do expect this is probably a reflection of the fact we've seen such strong growth in that market, and there's fewer people able to afford the borrowing, basically, to keep paying the money that people are expecting in a market like Dunedin where there's been such strong growth. So we have seen that slowdown occur a bit faster in the Dunedin market. And just a note there as well, of course, we will see August sales volumes disrupted by the lockdown, but harder to transact in lockdown. And so we expect that to affect the volumes once we do finalise August sales. So it's going to be very hard to use that as a comparison year on year, for instance, when you have such strange circumstances affecting the market. So just one to watch out for once we do start to report August figures. Of course, going to be impacted by the fact we've been in lockdown. I know that in terms of what's happening, what's this led to? We know we've got all-time low listings levels as well. And I know that we're going to talk more in detail and really shift to Gav to talk about that stuff because it's Trade Me specialty. But what we've had is low listings, high sales volumes, and that's really led to really stretched affordability. And according to a couple of our measures, we measure affordability on a number of different ways. The value to income ratio, the years to save a deposit, so for how hard it is for new entrants to get in, rental prices compared to income as well, so another measure of how much people are paying in rent, but then also those that are already in the market, how much of their share of their income is going towards their mortgage payments, really reflecting the impact of interest rates. And so this chart on the left-hand side just picks two of those measures, years to save a deposit in red, and you can see there that's been growing exponentially in the last few quarters. And also the blue line, which is our share of your income going towards mortgage, that has actually started to lift. And I think this is the most intriguing one now. We've seen that drop away over the last few years as interest rates have dropped. So even though yes, prices have increased, people that are in the market have found it more affordable to hold on to property. But the flip side, of course, has been that those trying to get into the market have found it tougher and tougher. And I think that's a big reason why we talk about the market has got so political, why we've seen so much government intervention, why we've seen the Reserve Bank weighed in a number of different ways. It's because affordability has become so stretched, and we've seen the split in the market. But I think the thing we're noting now is that this change in repayments, the share of your income going towards mortgage payments, is also starting to increase. And so even current mortgage holders, current property owners need to adjust for this as well in the future. And then finally on this, I think, it's worth acknowledging that, it's going to take a long time for any affordability to improve unless we saw a significant drop away in prices, which no one's expecting. It takes a long, long time to sort of come back to any level of normality. And that right-hand side just shows where that years to save a deposit is at, the red line, similar to on the left-hand side. And then a few scenarios pushed out to the right-hand side there saying, if we see a 4% growth in incomes every year, and then the different scenarios being if prices continue to rise at 2% per annum, which is pretty low, but still rising. Prices are flat and grey, or prices do actually drop 2% next year and the year after. They still would take a while to come back to that sort of average of 8 years to save for a deposit, and that's similar when you look at the value to income ratio as well. So I just think it's worth acknowledging that this affordability pressures are here for a while yet, and it's going to take some time to see any significant adjustment from that perspective. Anything on an affordability, Gav, before I sort of move on to who's been active in the market?
No, let's jump into the investor side of things, Nick, I think.
Yeah, I think that it's really worth looking at, what's happened with activity recently. We know the Reserve Bank, government have been very hot on, looking at investor activity, and there's been so many adjustments in this part of the market. And so we use our buy classification data, which is the chart on the left-hand side there, to really understand who's been active in the market, looking at transactions that have occurred. Is it a first home buyer? Is it an investor using a mortgage? Is it someone that's shifted house? And I think something we've seen, if we just hone on the right-hand side of that left chart, you can see there that light blue line. It gets a bit messy with all those lines together, but you can see that light blue line. Certainly, investors using a mortgage increased their shares significantly in the last 18 months or so. But we've now seen that adjustment back down quite considerably as those loan-to-value ratio restrictions have come in from 30% deposit requirement on the 1st of March, and now the 40% deposit requirement from the 1st of May for investors. We've seen their share of sales drop dramatically. And it's very similar to what we saw in 2016, which was the last time the restrictions had a 40% deposit requirement on investors. And of course, who's made the most of that less competition in the market? It's been first home buyers. That red line has jumped up again quite considerably in the last couple of quarters, to the point where so far in Q3, 26% of all sales have gone to first home buyers. But now we do shift into a time where first home buyers are now being looked at. And the Reserve Bank came out last week with a paper saying, yep, here's some confirmation. We're opening consultation now to adjust the owner-occupied limits, which will hurt first home buyers in terms of the amount of them that'll be able to have less than a 20% deposit getting into the market. So they're now being looked at. It's not just investors. The chart on the right-hand side, I'm not going to dwell on too much. It just shows the trend in 2016 compared to the trend now as those 40% deposit requirements came in, and we're seeing a very similar trend. So we sort of saw this coming, and we'll likely see that investor share continue to stay about where it is, much like it did in the end of 2016 when those limits were exactly the same level.
Nick, we've got a question from Joanne in Auckland just around the investor side of things in terms of, are you seeing or have you seen any movement from, I guess, the existing side of things moving into that new build? And I think we'll kind of go into the new build market in a little bit more detail. But, obviously the government tax changes and that sort of thing is trying to push investors into that direction. What's your take on what you've seen in the last couple of months?
Yeah, I think really good question, and really worth acknowledging that almost all the regulation and changes that come in, there's always an exemption there, and the exemption is always for new builds. There's still some work to be done on what is a new build and how long is a new build for, but it looks like it should be relatively generous. And it's probably a little bit too soon to see any adjustment in investors' activity for new builds because of the tax changes, for instance, without being able to write off their interest costs and their tax returns at the end of the year. But certainly from previous changes, we do see first home buyers, for instance, when they saw the exemption for new builds, being able to use a less deposit, we've seen first home buyers really fly into that part of the market. So I think that we are expecting a big change in that new build sector, and that is absolutely reflective of the fact that the Brightline test is different for if you buy a new build, your tax changes are different for a new build, your deposit requirements are different for a new build, and so we absolutely expect investors to take advantage of that, to continue to act in the market. And of course, that's generally a good thing because it adds to stock levels, and we know we are so undersupplied across the country, especially in Auckland, and so that encouragement towards new build is only going to be a good thing.
Great. Okay.
So I think that's probably it in terms of where my sort of state of the market is at. So looking back to what we've seen so far, we'll talk a bit more shortly about where things are going. I know a few other questions that have come in, and certainly it's around your guys' specialty, is around what's happened in the rental market. It's a real interest, I think. There's so many different parts of the rental market. We don't, have the same probably fast data that you guys do, Gav. I know you guys have got some data on that. So do you want to touch on what you're seeing from a rental stats perspective?
Yeah, sure. If you just flick through to the next slide there, Nick, this is our rental price index that we publish on a monthly basis. So this is July 21, and some really good talking points out of the July index. Specifically the fact that year on year, the median rental was up 10%, which is the biggest growth we've ever seen since we started our rental price index back in 2015. So some pretty good growth there, or actually significant growth. And I think that's probably the story on the rental market throughout the last 12 months. There's been some really, really big growth in terms of that median rent lifting. Interestingly enough, though, in March to May, we did see it cool down, and we do see that each year through winter, but it's lifted again in June and July. And I think that just talks to the uncertainty that's out there, that it's quite hard to get a handle on it, but we've still seen that really big growth that we would expect to see later in the year. It's kind of come through a little bit earlier. I think the other interesting talking points when you're looking at the rental market is I think what we're seeing down in Wellington is playing out across the country. So in July, Upper Hutt and Lower Hutt actually outstripped Wellington City in terms of the median rental price. And that talks to the fact that renters are willing to, I guess, compromise on that location side of things and move a little bit further afield in order to get a larger property. We know, and we're obviously living through this at the moment, your house and the size of your property is quite a big thing these days. And the fact that layered on top of that is people aren't commuting as much. People are only spending 2 days a week in the office. So actually doing a commute only twice a week is not too bad when you compare to 5 days a week. So we're actually seeing growth moving out of some of the main areas and into kind of the more regional side of things. So it is that wanting a larger property, and I guess, because people's lifestyles have changed significantly in the last 18 months. So I guess that's probably the big talking points. Seeing some really big growth. I mean, our view is it's not sustainable and it's going to have to slow down. But when that is, we're not sure. As we move into, I guess, the spring season and summer, we do see a lift there. So it'll be interesting to kind of see how that plays out. And I think the other point, what we did see, if we look back on last year, after the lockdown, we did see the rental market heat up pretty quickly, and we've got some data that I looked at this morning that's kind of showing our listings bouncing back really quickly as we drop down the levels. And what we did see is that lots of tenants out there decided that their rentals went up to scratch, and we did see a flurry of activity as soon as we moved down the alert levels. And I think that's what we're expecting to see again. People right the way across the property market, and it's not necessarily rentals. I think new homes fall into that category as well. People are making those sorts of decisions as to what their living situation's like, and wanting to make changes to that. So I think that's probably what we're expecting to see. And I think in terms of listings coming back and views coming back pretty quickly, it looks like it's going to play out pretty similar to what we saw at the back of lockdown last year.
Yeah, really interesting. And on that rental side, as you say, renters willing to compromise on location to get a property that maybe is more satisfactory for them and move a little bit further out. What's really interesting with that is it's the same with first home buyers. And what we've seen over the last 5 or 6 years is first home buyers, even though the market's been growing quite considerably, they have to get larger mortgages, they're still finding their way into the market. And a big thing that first home buyers are doing is being compromising on location and property type. So they are moving further from town. They have, gone and bought those townhouses and terraced housing type properties, even though obviously ideally they'd love to buy a single unit standalone dwelling. So, those renters moving out that way probably is a good early sign of exactly what they do once if they can move into buying that first home as well, that they've seen that behavior change. You've seen that behavior change earlier. And then once they go to buy their own home, they do the exact same thing, and they're happy to go and buy a little bit further out, as you say, especially now that you don't need to do the commute as frequently as well. So it doesn't matter necessarily that you're not so far from town. And especially if you've got decent-ish infrastructure and public transport, that when you do have to go into town, it's not too much of a drama as well, and you can be relatively relied upon. So I think that's really interesting for the fact that it is quite consistent across, that whole life cycle of someone's, living situation, renting to first home buyer and moving further from there too. So really, really good point.
Yeah, and I think that's a good lead into another topic that is we've kind of already touched on it now, is that new build side of things, Nick. I think we should spend a bit of time having a chat around that. So pretty keen for you to kick us off with what's your view on this segment of the market.
Yeah. Construction obviously just so interesting for everyone, right from, governments trying to get involved and wants to, make sure that we see building continue on. But, right through from we are seeing that consumer behavior change as well. And, some of the stats that I had a look at, consents for new builds at the end of last month were above 45,000 for the first time. So that was for July, sorry. So we get August data from Stats New Zealand a little bit later. but about 45,000 properties consented for in the year to the end of July. And a key part of that is the fact that we are seeing smaller dwellings to the fore with that. So that chart on the left-hand side just shows you that increase in the number of properties being consented, and in blue there, I think it is. And then the red lines to show you the share of those properties that are smaller dwellings. So this is apartments, this is townhouses, it's these shared unit, shared wall type properties that we're just seeing more and more be consented for, just reflecting the fact that we need to see intensification, especially in our main centres, and especially even more in Auckland. And that's certainly being adhered to or embraced by developers and by buyers alike. The chart on the right-hand side just shows you who's been buying those properties. This is our nationwide buyer classification, but for new build properties only. So looking at when new build property is sold, who's actually buying it. And you can see 10 years ago, that red line, those first home buyers, they weren't very active in that market. It was very much dominated by movers, by people that are probably upgrading their property, moving from an older property to going and maybe building their dream home once they've been in the market and created some equity for a while, and still quite dominant by investors as well, both those with cash and also those that are using a mortgage to buy that property. But in the last 10 years, we've seen a gradual change in that, and we've seen those first home buyers really drift towards new builds, taking advantage of lower deposit requirements, taking advantage of the fact that new builds compared to existing properties actually are quite comparable in terms of the value of those properties as well. And so if you can build new, you might have to build a bit further from town because you need to buy the land first, but you get a new property, so hopefully it's nicer. You get a bit of influence over what the property looks like and how it's built, and hopefully have less maintenance in future as well. And so that's where we've certainly seen those first home buyers drift towards that part of the market. The interesting thing, of course, now, as we've spoken about, those investors are essentially being encouraged to build and buy new properties now. And so while we've seen 25% of all new builds in the last few quarters go to first home buyers, they're going to see increased competition in that market now, and that might see their share of those properties start to drift below, and first home buyers are going to have to reconsider buying those existing properties, slightly older properties maybe, and getting back into the DIY mode and fixing up those properties, because it's going to be more affordable to do so in the short term with so much competition for those new builds. So certainly one thing to look out for, and maybe an unintended consequence really of all the changes for the investors shifting towards that market. It's going to crowd out those first home buyers who now have to relook at existing properties, which may not be of the same level of quality, and leave a bit more of a burden on those first home buyers in future. So that'll certainly be one to look out for in the future, because we have seen such a dramatic shift in the market. The regulation is going to change that in the future. But I know from your perspective that you've seen changing figures in your stats as well, and so just wondering if you've got a bit of a feel from what's happening from a demand perspective, and what are you seeing from search behavior on your site as well for what people are looking for from a new build perspective.
Yeah, we've seen significant growth here in the last 18 months, and the graph that I've got up on screen here, hopefully everyone can see it all right. And I did chuck some arrows in there, but I guess my formatting is not great because they've disappeared. But if you look on the left-hand side there, around about February, we kind of February 2020, we kind of peaked interest in terms of our new home category. So on Trade Me Property, we've got a dedicated new home category where we pull out all of those new properties for someone that's kind of quite far down that funnel, so they can just jump straight on and have a look at purely a new build. You can see we kind of peaked there in February 2020, and then we went into lockdown, it dropped, and you can see that a massive spike there around May in terms of that interest and that demand in the new build side of things. And I touched on it before, like we were saying with the rental side of things. People were making decisions based on what they'd kind of been through in lockdown, and lots of people were going, well, actually my house isn't fit for purpose, it's not fit for the kind of the COVID world that we're living in. I actually need an office, I need an extra bedroom and all that sort of stuff. So we saw a huge demand increase on the new build side of things in terms of views, and people going out there and looking actually what is on the market, what are your options, and giving that good consideration. It dropped away a little bit, but you can see that it's remained really high, and I guess that green dotted line there kind of shows that trend over time, where it is trending up, and it's still looking at really high levels compared to that February 2020. In fact, our views are up around about 26% in this category, so it really does talk to the interest that we are seeing there. And if you just flick through to the next one, then Nick, and this shows email contacts. So we monitor obviously emails that we send out to the industry, and very similar story there in terms of that growth. And I think this for me just shows, hey, people are looking at it at the category, but they're actually making decisions in the category. And I think, and the numbers are like 195%. Up in terms of emails, and that's not coming off an insignificant base, So again, that trend line pushing up, which is really, really interesting to see that people are looking at it, but they're also making the intents there in terms of actually finding out more detail and moving into that. And I think what we have seen in the last 12 months is that our total new home inventory is up around about 10% year on year. So we're seeing more of the property coming through. And I think you touched on a good point there. We're talking about the townhouse side of things and people who are willing to kind of make that compromise. We talk a little bit about the quarter acre dream as well out of reach for certain people, especially if you're living in those large metropolitan areas. And, I think that's where people are, a lot more open to living in townhouses in order to kind of not compromise as much on the commute side of things. And the other side of things that we are seeing is there are a lot less maintenance, which for new home buyers, your graph there, Nick, showing the interest is it's quite appealing to the new home buyers, and we've seen a lot more developments, both big and small, coming onto site, particularly around that Auckland area. And then if you touched on the affordability side of things. In terms of the townhouse side of things, the average asking price on a townhouse in the month of July was $817,000, which is up 26% on July last year. So I guess it does show that demand side of things, and we are seeing record asking prices nationwide. And just to give that a bit of context there, 5 years ago, back in 2016, average asking price was $639,000. So that's some pretty big growth, and I think that's, like you're saying, Nick, is if it keeps going, then we're probably going to see those first-home buyers coming back to the existing side of things because of those price points keep creeping up. And then in terms of the demand on the townhouse in particular, if you look at apartments, the national average for asking price for apartments was only actually up 3% year on year. So that demand is really focusing in on the townhouse side of things.
Yeah, really interesting. I think you've touched on a couple of points there. I think there was a question from Calvin and Rosedale who actually asked about the impact on new build price and mortgage criteria requirement due to lockdown. That's not necessarily due to lockdown, but obviously very interesting to hear those, the asking price for new build properties and how much that's increased. So I think that's a good figure to reel off there. In terms of requirement due to lockdown, I think we will see a bit of a pause in the market as people can't transact. But as we do come out, I think we've spoken about how much that will change as we come out. And then one thing I didn't talk about when I had this slide up before as well is that we do need to acknowledge that costs are really increasing at a significant rate right now for new builds, and it's harder to get the funds for construction as well. But of course, having that exemption will help. So I think it is a changing market. Those costs are starting to be passed through to the end buyer, whereas what we had seen, say, late last year and early this year, builders and developers were being able to, I suppose, shoulder some of that increased cost themselves, but they're now passing that on as well. And so we are going to see that new build cost start to flow through, but that's more due to capacity constraints on the market as opposed to the impacts of this lockdown in its own. But of course, if this does go too much longer, we must start to see that grow even more. So certainly one thing to consider. I think from a mortgage perspective, and credit criteria, look, I think the Reserve Bank and the government will not want to see the new build market tighten up anymore. And so they'll be certainly paying close attention to where the banks might be tightening up or otherwise for new builds, because they don't want to see that slowdown in that sector. They know that they don't want to have this big boom bust fail of the construction industry, and they need to see credit flowing freely for those new builds to keep up at pace with what we need to do. So they'll certainly be paying a lot of attention to that. Some of the biggest changes recently have been the banks adjusting their deposit requirement for smaller apartments. So a good change there, where it's all well and good having a small apartment be cheaper than buying a big property. But if you still need a 40 or 50% deposit for it, the requirement for someone to get into the market is just as bad as having to get that deposit for a big house. So seeing those banks adjust those down because they're not quite as risky as they used to be in terms of lending to apartments is great news. And hopefully we continue to see some adjustments in that part of the market as well. So I think there's continual change here. The banks are using more and more data to see that there's not as much risk as there used to be in apartments, but certainly they're going to still be a little bit more cautious than otherwise. Your stat there in terms of the increasing price of apartments, also not a surprise. We see the same thing with our data with sale prices and with the value of apartments. And I think the reason we haven't seen the same growth is that there is less demand for it in terms of tenanting or buying it. With the borders closed, of course, we know that especially in Auckland, key markets for the apartment sector are short-term accommodation, such as Airbnb, as well as international students. And with the borders closed, obviously there's fewer and fewer of those people. And so that's meant there's been less demand for those properties. And that's also led to less investment. And that means those prices haven't grown at the same level because there's not the same demand either from a tenanting or an investment perspective. And so it's not too much of a surprise to see that. But again, maybe an area where there could be some more growth in the market once the borders do reopen and we get back to some level of normality from a tourism and international student or studying perspective as well. So I think there's some changes to come in that market too, but it is the big market that's got the most uncertainty as we remain with our borders closed.
Yeah, and I think that, the last point that I'd add in there, Nick, as well, is what we've seen over the last 3 to 4 years is confidence from buyers out there in the market. They're a lot more comfortable buying off the plan than what we saw 3 or 4 years ago. People are a lot more used to the process. There's been some good investment from some of the large builders out there in terms of, getting them comfortable buying off the plans, which has been fantastic. And you can kind of see that coming through, which is really encouraging. And I think that's only going to continue as people are looking more, as we can see the demand there from the new home side of things.
I love that. I love that point. And confidence is such a crucial thing throughout the whole market, and there's good consumer confidence surveys out there which do talk about people's confidence to continue to spend, continue to buy, and all the way through to, giving confidence to developers and builders to know they can continue to build, continue to develop properties, and there's going to be a big market there. So I don't think we should underestimate the impact of the strong confidence that we have here in New Zealand. And that's because of, how strong our economy has been, how strong we've seen our property market, and that's just leading to people being more comfortable to continue to act in a market that's has some uncertainty, but they can still have that confidence for the long-term growth.
Absolutely. Hey, let's change it up a bit here, Nick. And I love a bit of crystal ball gazing. So I'll chuck you on the spot here. What are you predicting as we come out of lockdown and the country moves down the levels in the months ahead?
Yeah, and I think we've kind of already touched on it. That short-term bounce, that short-term boost of prices, and in the temporary time when we come out of lockdown. And I think a big part of this, we've sort of touched on it, and you'll, I think, follow through with your listings views, and we kind of try and gazump you here, where we go, well, even before someone lists, they need to talk to an agent. And an agent does an appraisal. They generate an appraisal through products such as our own at CoreLogic, RPNZ, Property Guru, and we see that that's a really good lead indicator for a listing coming to market. Not every property that has an appraisal goes through to being listed, but we do like to track those because the trend in what happens with appraisals being generated generally leads what happens with listings later on. And so we do track this. We started tracking this in lockdown last year. And so you can see that chart on the left-hand side. It's got a long time series here, 18 months. You can see what happened last year. The darkest grey bars or shading is when we were in lockdown level 4 last year. And you can see that blue line as we move to level 3, increase significantly, level 2, and then the white part is obviously level 1. And so we've seen the impacts of all the different shifts in alert levels over the last 18 months. And again, now we're tracking those number of properties that are having appraisals generated by agents. And we see that it's very difficult for an agent to go out there and appraise a property, and that drops down significantly. It didn't drop down as much this time around as it did last year. Activity essentially dropped 50%, whereas last year it dropped over 70%. So agents were still able to do much more activity than they were last year. And then again, we're seeing this bounce back as we've come out of lockdown level 4 into 3 for the rest of the country. and this would obviously be greater if Auckland was included in this level as well. So it's jumped back pretty well, and we expect that to continue to grow as we move throughout the levels, and hopefully Auckland moves into level 3 relatively soon too, and give that short-term boost to listings. But in the short term, because we've seen that lack of listings come to market, or will be able to come to market, we do expect that a drop in supply, increase in demand, because we do have all those people sitting at home, many people browsing Trade Me and the like, and looking for property. Short-term drop in supply, short-term increase in demand, we'll see property prices boost in the short term, but we don't expect that to be consistent over a longer period of time. And that table on the right-hand side is, I suppose, our attempt to go, well, you know what, this time is different to last time. And when we went into lockdown last time, there was so much stimulation in the market. You know, it wasn't just support from the government trying to ensure that people didn't lose their jobs. There was real stimulation of the property market, and the number of factors that we talk about here, and that is, you know, wage subsidies exist both times. There's been some form of business support to some degree both times, more so this time probably than last time. But there's a number of things which aren't present right now, and these things were so stimulatory. They are what caused the market to grow at such a strong rate, or a big part of why the market grew so fast, which aren't valid this time around. And we worked through all those. Of course, the official cash rate dropped from 1% to 0.25% last time. This time around, we're almost certainly looking at a lift to the OCR. We had quantitative easing, we had the government, we had the Reserve Bank buying government bonds, and that's really to try and keep those interest rates low, to encourage people to still spend and keep our economy afloat. That happened last time. That government bond buying has now finished, so we're not going to see that reenacted, I don't think. So that's a very big difference this time around, and that, again, we'll see interest rates start to lift. We had the LVR restrictions, the loan-to-value ratio restrictions. They were taken off temporarily last year. Initially for 12 months, they ended up being off for 10 months in the end. But that, of course, was also very stimulatory. We saw investors take advantage of that, not requiring that 30% deposit. They got into the market without that requirement. And where this time around, we've obviously got harsher LVR requirements now than we did even prior to lockdown in April or March last year. So that's going to mean there's less stimulatory impact to the market. We also had the mortgage deferral program. So if you were struggling to pay your mortgage, or you weren't sure what was happening with your job, you could defer paying your mortgage for a period of time, at least 6 months. This time around, that has not been reenacted. Of course, the banks will still work with clients if they need to, but it hasn't been mandated or really enabled by the Reserve Bank this time around. And so again, that's another reason we don't expect to see, the property market take off. And then finally, because we've seen such strong growth in the market, housing affordability is just so much worse today than it was 18 months ago. You look back to April last year, the average was 8.8 years to save a deposit. Now that's increased by almost 2 years to 10.6 years. So we do think that longer term, the market is very different right now. While there might be a short-term boost to prices, long term, we do expect that slowdown, that trend we saw prior to lockdown, to probably be, come back into the market in a month or so. And we'll see that value growth start to slow down once again, just because all those factors are not really contributing to increase in property market, and really to that slowdown. And as I touched on earlier, the final factor here is, of course, not only are investors under the gun from an LVR perspective due to financial stability, we're now seeing first home buyers targeted. As I mentioned, Reserve Bank released this paper last week talking about tightening up the restrictions for first home buyers. So currently there's a speed limit where at least about 20% of new lending by banks to owner-occupiers can be done with less than a 20% deposit. That's going to shift down to 10%, so only 10% of new lending with a low deposit or a high LVR. And what we can see here is that most of that allowance is taken up by first home buyers. The red line shows you that 77% of all exempt lending for owner-occupiers is used by first home buyers. And also the blue line is another way of looking at it. It shows you that 38% of all first home buyers who purchased in June this year had less than a 20% deposit. So that's going to shift dramatically down. And so we will see some first home buyers unable to buy that property with those changes, which are supposed to be enacted on the 1st of October, but they're currently under consultation. So we'll wait and see when they're confirmed, but that certainly will be a significant impact on the market if and when those changes come in. So very big difference now than what happened last year. And for that reason, we don't expect that continued growth to happen as we move throughout the rest of this year and into the start of 2022.
Yeah, that's a great bit of analysis there, Nick. I really like that comparison. I think the bit that I'd layer at the top of that is just a bit more certainty in terms of, what we, a bit more confidence in terms of what we kind of know than what we did back in April 2020 as well. I think that's the piece that has changed a lot as well. That we're kind of rolling the punches a little bit more now, and we can
Very
kind of
true.
have a little bit more confidence around what that recovery will look like. And I think if you kind of look at it from our perspective here, so this is just I guess a comparison in terms of our listings and our views on Trade Me Property back in April last year. So the graph above shows our listings being hit quite hard in terms of the residential for sale side of things come the end of March, there dropping off and then plateauing away while we kind of did sit around in that level 4 for a long period of time. But what you will see there, as soon as that May kicked in and we went down those levels, bang, they were straight back up, and we saw a really big bounce in that. And we talk a lot about the V-shaped recovery where it went down and then it came back just as high. And then if you look at the view side of things, really same side of things there in terms of drop down and then came back up. And our views have been an interesting story this year. Obviously, the property market has been particularly hot, and the supply side of things has remained a challenge. But we've grown our audience this year around about 13% on the previous year, which, when you think about Trade Me Property that has such a large audience as it is anyway, growing it by 13% is pretty significant. So you can kind of see that year-on-year trend on that bottom graph in terms of our audience growing over time, which has been fantastic. And from the inventory side of things, it bounced back and then remained at a pretty steady level. We didn't see any significant growth there. So that was what we saw from a recovery last year. And then I think the other bit that I'd layer in there is, Auckland has gone into level 3 a couple of times now, and we don't really see too much of a change at all in terms of listings coming to site or to our audience under level 3. And if you just move through the next slide there, Nick.
Just before I do, Gav, I just want to point out that green line's really interesting. And that's what I think we're talking about, where that views green line, actually, there were more views occurring on average after we came back from lockdown than it was happening prior to lockdown. It just shows that level of pent-up demand as people did come out and actually seriously wanted to see what was going on in the property market and check those properties out. So I think that's exactly the boost we're talking about now, where everyone's sitting at home and they come out and start to actually look at properties. So I think it's worth just noting that bounce was actually stronger than what it was prior to lockdown in April last year.
And then, as you say, Nick, and the fact that supply has been constrained and over that period and not been able to be satisfied, we've seen that the demand not being satisfied. We've seen that continue for a longer period of time. In terms of the recovery. And I think if you look at, this is just data that I actually pulled this morning, so we're obviously monitoring what's happening to our listings and our views, and a similar story from a listing perspective. So the graph above property, which is our residential for sale side of things, those green bars are our listing counts that come to site on average. So we're early in August, when lockdown was a distant memory, we were trucking along as per normal there. And then dropped away significantly. And then what's interesting there is you can see those two graphs there. The line spiking up. That was Thursday and Friday last week as we moved down the levels. So we've seen the inventory side of things bounce back, and the rental side of things not as significant, but actually the graph that I was looking at this morning, we've seen a big increase in rental listings coming back yesterday. So not coming back last week, but have bounced back significantly and nearly back to normal levels. The audience side of things, though, has been interesting. So whilst the audience side of things has dipped a little bit, it actually hasn't fallen away as much. And I think that comes back to that that confidence, a little bit more certainty around what we're seeing. People are still looking at property and are expecting, listings to start flowing back. So our audience side of things haven't been impacted as much as we saw last year, and obviously a shorter period of time in terms of the lockdown side of things. But the market is acting as we kind of predicted, and as the country moves down to level 2, we'll see those listings around New Zealand bounce back. And then once we get that announcement and a bit more certainty from the Auckland side of things, we'll expect to see a good load of Auckland listings coming back onto site, and we'll be bouncing back. So predicting a pretty strong end to October, and then a very strong November, and obviously moving into that spring selling season as well. So timing's good for people to be out and about looking at property as well.
Yeah, good point. It's probably, not the worst timing in that perspective, I suppose, to be, locked down now and then, as you said, come into that spring and early summertime where people are very active in the market. So it probably is very lucky timing from that perspective, because it'd be much worse if it was a few months ago, I'd say.
Absolutely. Hey, last bit to kind of close on here, Nick, was, prior to going into lockdown, there was a lot of talk about the inflation and interest rates and that sort of thing. And you touched on the official cash rate there. What do you think a little bit more medium term in terms of what's going to be happening on the OCR and that side of things?
Yes, I think, when we kind of almost ignore what's happening right now and say what was our commentary, say, a month ago before all this occurred, I think that's where we start to say, yeah, it's all about inflation and interest rates. And that's been the rhetoric coming from the Reserve Bank, certainly worldwide as well. Central banks worldwide are talking about this as well. And the key point, I suppose, here is the inflation chart on the left-hand side, which shows that inflation in the latest quarter of data went outside the mandated band that Reserve Bank want to keep inflation between 1% and 3%, hovering around that 2% mark. And we saw inflation jump to 3.3% in the latest quarter of data. And that's really where the alarm bells start to ring, that if they see inflation so strong, it means people are out there spending lots of money. And to slow that spending down, they can lift the interest rate, lift the official cash rate, which does just make people hold a little bit more, and means that we're not seeing the price of everything increase so hard because we don't have such a hot economy right then. So that's one thing they're talking about. The key question many economists have is that inflationary pressure only temporary? And so you can look through it, as they say, and it'll come back by itself? Or do they actually need to adjust the official cash rate to get ahead of that and bring that inflation back down? But it's pretty much across the board now. The official cash rate is expected to increase. The Reserve Bank themselves admitted that had we not gone into lockdown literally the day of the last monetary policy statement that they made, they would have lifted the official cash rate. So I think it's pretty much all on the cards. October 6th is the next decision date, and everyone's expecting at least a 0.25% increase to that official cash rate. And of course, we know the key reason that's important, it'll flow through to mortgage rates. So not just those obviously wanting to get a property, but those that currently own a property and have a mortgage. Next time they come to fix their mortgage, they're going to see those rates start to increase, and they need to prepare for that right now. Some of the feedback we've had is that many people, as they've seen interest rates drop, they have actually kept their payments the same size, and so that might cushion them a little bit once those interest rates start to lift, and won't cause a problem for the market. We don't expect interest rates on their own to cause a drop in property prices. Typically, it's only when we see a significant shift in our economy, we see a lift in unemployment, and we see a real uncertainty from an economic perspective, that we see property prices drop, not solely due to interest rates, especially when you think about the lift there. And the chart on the right-hand side is the official cash rate forecast by the Reserve Bank, which some people will trust and some people will not. But it does give an indication of their expectations in the future. And it's a relatively gradual lift in the official cash rate. It's not like it's going to go from 0.25 to 2 within 6 months. It's going to take a bit longer for that to happen. And so people should have time to adjust their spending habits and their mortgage payments over that period of time, to be able to continue to, afford to own their property, essentially. And so we're not expecting to see, because interest rates increase, that suddenly people are forced to sell their property because it suddenly costs them too much to own that property. So I think when you're looking at longer term, yes, the fundamentals pushing the market up are reducing, but we're not expecting, these massive headwinds to force prices down either. But the official forecast from the Reserve Bank themselves is certainly that they do expect the market to continue to slow. And we'd agree with this forecast, but probably not quite the same rate that they are. We do expect the slowdown to be much more gradual, and that blue line, really to be a bit more flatter, I suppose, than the immediate drop that they've got in their official forecasts. And they've got prices sort of dropping in the coming couple of years. Again, it'll be interesting to see how that one plays out. Again, there's no real reason to think that people would accept lower prices unless we do see an economic shock and people start to, want to get out of the market because it's not profitable for them at the moment, at that time. And investors will certainly be a key part to this. If the yields are not there, the price growth isn't there, and they're struggling to find tenants or anything willing to pay the rent they need to make it profitable because their costs have increased, then we may see investors want to get out of the market. And that's certainly something we'll be looking for, especially how that compares across the country. Because while you can have a forecast, nationwide that says prices might drop 4% in 2023, the key thing is going to be, how does it change region to region? And that's something we'll be working on over the coming months to say, some of these areas are more vulnerable or less vulnerable than others. and that'll be what's of interest to many people, I think, rather than a nationwide forecast. When you're going to see differences across the country. Auckland will be different to Gisborne, will be different to New Plymouth, will be different to Palmerston North, will be different to Queenstown, will be different to Gore, for instance. So we'll be putting more real solid data around that to understand how things might play out longer term by region rather than just a nationwide figure. So I think that's what we'll spend our time on in the coming months.
Yeah, I think that's a great point, Nick, as well. I mean, we're looking at the Christchurch market at the moment and looking at some of the growth we're seeing down there from, both a rental and a for sale side of things. I think that market is going to probably, do the opposite potentially. I mean, there's huge demand down there at the moment. So, I think the regional side of things will be a little bit more interesting than just looking at that nationwide side of things. So I look forward to seeing the analysis that you guys are doing on that. Hey, just to kind of round us out for the session, let's just jump into a few questions and see how many we can kind of get through in the next 10 minutes or so. Mark from Christchurch asked, is now the best time to invest in property, or should we wait to see how the market adjusts over the next 6 to 12 months? Just chuck you on the spot.
Eh? Always a tough one to answer. I think that as per usual, I can't give personal advice, so you can't take it that way. And I think what this does come down to is personal circumstances and the location of that property too. I think the key piece of advice from my perspective is to say, you need to be cautious with your calculations. If you're buying long term, there's still good reason to buy property, especially if you've got money and you've got nowhere else to put it, or you don't see any other area to put that money. But I think you need to be cautious around your calculations and have an extra bit of buffer to cover for unexpected costs, or just the fact that you're going to have that uncertainty in a longer term future as well. You need to prepare for whatever your mortgage payment is going to be today, it's likely to increase in the future. Can you handle a period of vacancy if your tenants are vacant for a period of time? What does that look like if you have a property vacant for a while and you don't have that income coming in, but your costs are still quite high of owning that property as well in that short-term period? But I do think that long-term, there's still solid fundamentals there, and we're not expecting prices to drop. So as long as you're looking at it and you can make the finances work in the short term, then longer term, you should still be okay. If you've, as the classic says, someone else is paying off your mortgage and you're reducing your debt over time, your equity is increasing, then you should be in a positive position. And I think the other thing to acknowledge here is that I think it was over the weekend, once again, the government, Grant Robertson, got asked, do they want to see prices fall? And he reaffirmed their position was they want to see prices increase over the long term, just at a more sustainable rate. Now, you can take that in many different ways, but we still consider that as, almost a government guarantee that if they can, they don't want to see prices drop because they know New Zealanders have so much equity in property. And I think what that does is give further confidence that they're not expecting or wanting property prices to drop. Now, they can't control the market completely, but where they can, they will look to protect the wealth of those assets. And so I think, again, that kind of gives almost a government guarantee that we're not expecting prices to drop significantly. You might see drops here and there. Short term, of course, we're not going to guard against that completely. But over the long term, they don't want to see a significant drop away in prices. And you look at the global financial crisis, prices dropped 10%. And that 10% drop on the longer term context is not that significant. So, we haven't seen prices drop that much in the past, even with a global financial crisis where unemployment increased. So we don't expect to see that happen in the near term future. So, I'm not going to go out there and guarantee it's not going to happen, of course. But I think there's a number of factors there which should give confidence that if you've got the money, you can make the finances work, that there's no reason not to be confident in the long-term future as well.
Yeah, and I think, coming back to your point there, Nick, around the buffer side of things, I think that's going to be interesting as we see that OCR change in the short to medium term in terms of, people who have made those decisions, what that buffer kind of looks like for them. And then obviously as we move forward as well. Antonia from Auckland asks, what changes do you envisage to buyer demand levels over the next 6 to 12 months?
Yeah, cool. Where am I? I suppose, yeah, look, we sort of talked about a few of these things that we do expect demand to reduce. I think there's two things here. There's reducing due to ability to buy. So credit's getting harder. The LVR requirements are tougher, and interest rates are starting to increase, which means you can't borrow as much today as you could last year. And so you can't pay the prices properties necessarily got to. So that's affecting people's ability to even be able to buy property. And then I think the other side of it is just, are people willing to pay the prices as well? And that's more from an investment perspective. And I think that sort of talks to my last point where, the finances of buying a property a year ago were much more attractive than they are today, especially with those interest deductibility changes, which mean, you need to be essentially getting more income from your rental property than you did a year ago. And so those fundamentals have changed a little bit as well. So demand from an ability perspective is certainly going to reduce, and also from a willingness perspective to pay the prices when you can't make the same amount of money in property in the short term as well is going to reduce. So I think there's no doubt buyer demand will be reducing in the next 6 to 12 months. The key question is going to be how much. And if it did reduce too far, then you do see it start to switch to a buyer's market as opposed to a seller's market. And that's where we start to see more competitiveness with prices in terms of, people, that price is starting to not be accepted at that high level, and we start to see properties sell at lower prices, but not necessarily to a falling degree. So that's the intriguing part for me, but certainly demand we're expecting to reduce over that short to medium term.
And coming back to what you were touching on before, Nick, I think that will be at a regional level as well when we kind of break that down, where we see those markets tipping over to a buyer's sort of thing. So it'll be interesting to keep an eye on what regions they will be. This is a long one, but a good one nonetheless. While we always want to be acting in the best interest of a vendor, is there anything we can do as agents to keep people calm and avoid making or expecting unrealistic offers that will prevent them from selling in the case of the vendor, or that will saddle buyers with precarious debt? That's a big one, Nick.
Yeah. To me, there's a simple answer here, and that is, I'm a data guy, data geek even, and I think the key thing is use that data, use the information you've got at hand to show that the market's starting to shift, show that those prices that were achieved 6 months ago just aren't happening anymore. Do what you can to get as much information about those comparable sales that you can find through the different products that are out there, including CoreLogic, of course, to really show the impact of those recent sales and how, those properties that are being sold most recently are not fetching the same price as those that were selling 6 months ago, for instance, and really show how, comparable those properties are, to say, look, I know you expect to get the same as, Barry down the road 6 months ago, but the market's changed in that time and people aren't willing or able to pay those prices. So there's plenty of content and information out there put out by the likes of ourselves, Trade Me, many other organizations out there, which will be showing that reduction in the growth rate and telling people that you're best to probably act sooner rather than later if you are coming to list the property and achieve that sale price that's going to be, beneficial for both the vendor, but also for that buyer, as they say, if they've got some consideration for them and how much debt they need to buy that property, then certainly, it's going to be beneficial for them too. So yeah, ultimately, use the data, use the products out there to pull that information together, create that compelling story, and present that in a nice way to that potential vendor.
Yeah, just a bit of a plug for Trade Me Property here as well, in terms of our real time demand and supply side of things. Have a chat to us, get in contact with your representative, and we've got some access to some real time stuff there as well that we can layer in with your CoreLogic data there as well, Nick.
Recency is so important, right? The recency of data, and anything you get that's real time, that's the business.
Hey, let's finish with the last question here. Where should we go? Nathan from Rumia has asked, is news of rising interest rates putting pressure on buyers to act faster or making them think twice about affordability and slowdown?
Yeah, another good one. I think that what we've seen, and most of it's anecdotal as well, talking to people, is that, again, if people are able to buy, they will. They're not necessarily going to wait and see, too much what's happening. Do they act a little bit faster? Maybe, but I suppose it all comes down to whether you're also pre-approved as well. So if you've already been talking to the bank, you've got a bit of time as well. So there's no need to necessarily rush. But certainly if you've got a purchase decision coming up in the next 3 months, and that could be slightly harder in 3 months' time than it would be in a month, and that is forcing people to act a little bit sooner than they otherwise would have. But I think most often people know that increasing costs are coming and they need to adjust for that and prepare for that. And so if you know increasing costs are coming and you might not be able to afford in the future, you may want to be cautious and pull back from taking on too much debt in the short term, because it's just going to saddle you with more problems in the future. So it's probably a little bit of both. I'd say more of people saying, yep, I'm willing and able and I've got the money to do so now. I'll do so sooner rather than later, rather than those that are holding off. But yeah, bit of a mixed bag, I'd say, but mostly towards the first part.
Cool. All right. Well, let's call it there, Nick. Hey, thanks very much for your time. Really enjoyed the conversation. Good to get your thoughts on the market, and yeah, big thanks to everyone that's tuned in. Hopefully you found it valuable, and that you're all getting on all right out in your bubbles out there. But yeah, look, thanks again for your time, Nick, and give your podcast a bit of a plug there, mate.
Appreciate you. Anyone that's seen me speak before knows that I never miss an opportunity to plug my podcast or our podcast at CoreLogic. And I think, as we've spoken about today, things are fast moving. That OCR expectation was 2 months ago, was that it wouldn't lift until next year or ended next year. Within 2 months, it's now potentially going to lift 0.5 at the next thing. So the thing for us is that Calvin's our chief economist. We have a weekly podcast where we are discussing all the most recent changes. Reserve Bank keep us on our toes with the releases all the time, all the data that comes out. And we're always talking about that every Monday morning. So we have a podcast every Monday morning, about 20 or 30 minutes, where he and I just chat about the latest data and what it means for the property market. So if you're a podcast listener, on your commute, once you get back to commuting or on your exercise routine, please do go and check it out and let us know what you think. You can scan the QR code right there in front of you. It'll take you directly to the Spotify version of our podcast, but it's also available on Apple Podcasts and all different podcast players. So please do go check it out. Let us know what you think, and we'll keep you in the loop with everything that's going on in the property market. And just a big thanks to Trade Me for organising today. I know it's a bit of work to pull these things together, but great to be involved and be able to chat about what's going on and get your insights too, Gav. So thanks very much.
Thanks, Nick. Enjoy the rest of your day.
Appreciate it. Thanks, everyone. See you later.
See ya.